The market may have rebalanced faster than expected, but for one area of the oil and gas industry, it's not business as usual, not even close. Demand and inventory is looking good for the oil and gas industry as COVID-19 vaccinations are doled out and the economy starts to return to normal, but jet fuel is still in trouble. Analysts now expect production, consumption, and inventories to normalize by the end of the first quarter, but jet fuel demand is set to be the last to recover as COVID travel restrictions remain in place. Bloomberg data shows that the volume of petroleum products supplied to U.S. consumers in the 4 weeks ending February 12th hit 18.7 million barrels per day, or 0.6% higher than the seasonal average for 2016 to 2020. Those numbers don't include jet fuel, though. Crude prices have rallied 20% this year, and global inventories are falling at a fast clip, with the Texas deep freeze helping by shutting in up to 40% of U.S. crude production last week. Still, those inventories are far above the average pre-pandemic levels, and prices are still below the levels that OPEC members need them to be. Goldman Sachs today boosted its oil price forecast by $10, predicting Brent would reach $70 per barrel in the second quarter and $75 in the third, returning to pre-pandemic levels by late July. But markets will be nervous about the upcoming OPEC Plus meeting on March 4th, especially with Saudi Arabia and Russia once again at odds over the cartel's next move. Moscow is ready to increase supply, but the Saudis have indicated they would prefer to hold output steady and remain cautious. Jet fuel is the key to a full recovery. Without this element, a return to full production by U.S. shale producers and a potential increase in OPEC Plus production would flood the markets. What it means overall is that we may need to see an increase in crude production in the very near future, but until the passenger airline industry is fully up and running, production will have to be kept at pre-pandemic levels, likely into 2022.